Key ideas in quantitative finance, futures and forwards. Our study of futures takes us to the Dojima Rice Exchange in Osaka, Japan in 1710, which was the first futures exchange in the world. The idea of having a financial derivative indeed is very ancient. It's not a modern phenomenon, it's something that has been with us for a very long time. The history has advanced very quickly, and we have futures trading in the 20th century in different parts of the world. We have it also right now going through electronic exchanges, but nevertheless, how this is done is always the same thing as was done with the rice futures in Japan in the 1600s. We want to buy something in the future, and we want to specify the price today. This is a future contract. So, the future contract indeed is a contract which gives the buyer the obligation to buy an asset called the underlying for a predetermined price called the forward price at a predetermined date in the future, the maturity. Here we have these three key variables: the value of the underlying at maturity, the forward price, that is the agreed price at time zero when we enter into the contract that we are going to use to buy the underlying in the future at time capital T, at the maturity. If we look at what happens with the cash flows in time, we can compare the futures contract with a spot contract. Spot contract is done instantly, it's done right now. I want to buy something, I give you the money, you give me the thing. Spot contract then, in the timeline, the investment line, is drawn as two cash flows today, one going down because it's a payment, we pay for the underlying, and one cash flow goes up in which we receive the underlying, that is the commodity or the object we are receiving. But it's all happening at time t equals 0 today. It's happening today. That's the spot contract. The forward contract or future contracts differ in that these cash flows, the buying and the selling, happens in the future, but it's pre-arranged today. We sign the contract, the futures contract, today at time 0, saying that in the future I will buy the underlying by paying capital F, the forward price, and receiving the underlying, what we have called here capital S underscore T. So here, by doing this, when I enter into the contract, I know how much I'm going to pay for that underlying at that time in the future. I know for sure, it's a certainty. And there is no choice. Once I enter into a futures or forward contract, I'm going to have to buy the underlying for that price at that time in the future. This leads us to this payoff diagram, which makes that if at that time in the future, at maturity, the price of the underlying, which we have here in this payoff diagram in the horizontal axis S capital T, if it's above the value of F, the forward price, we're going to be making a gain. Gains and losses are represented in the vertical axis. Gains are the positive part, losses are the negative part of H, which is the payoff of the forward contract. So, if gains are positive because the underlying is higher than the price of the forward, means that we, at that time in the future, are going to pay little, capital F, for something that costs more, and then we're making a profit. But if the opposite happens, if we agree to buy something for F in the future, and at the future the value of that thing is lower than F, then we're paying something more than what costs actually in the open market at that time in the future. So we're making a loss. That's why the payoff diagram looks like this, like a line which increases and it cuts the axis at F, that is the forward price, and is represented by the formula H equals ST minus F. How do we price this forward? Well, we usually do it through the no arbitrage argument. The no arbitrage argument says that all cash flows should be equal to 0. That for fair pricing, all the cash flows that I expect to receive in the future, considering the ones that are paid and the ones that are received, should be equal to 0. If that is the case, then a forward contract should involve at time zero no cash flows. There is just the signature of the contract. And at time t equals capital T, at maturity, then there are two cash flows for sure, paying F, the underlying, and receiving the underlying ST. Through the no arbitrage argument, we can put these cash flows here in what is normally called the cash and carry argument. And this shows simply that if at time zero we do the following: we sign a futures contract today, we borrow from the bank a quantity S0, the value of the underlying at time zero, and with that money we buy the security, so we have the security with us. We carry it into the future, and at maturity, what is going to happen? Well, we're going to honor the futures contract, and then we're going to sell the security for F, receiving capital F, the forward price, and we have to pay back the bank, of course. Let's not forget. We pay back the bank, considering the accrual in the price that the S0 increased to today. So the interest rates, the effect of interest rates in this period. If we do the sum of the cash flows at these times, at time t equals 0 today, we have that they add to 0, and we have S0 equals S0, which confirms the analysis, and that at t equals capital T, the maturity, if we add the cash flows, then we obtain a formula F equals S0, the exponential of RT, which allows to compute what should be the fair forward price for a contract. This formula is indeed the forward price based on the price of the underlying today, S0, on R, interest rates in the period, and capital T, the maturity.